Hello friends and welcome to Edu Notes. Hi, this is Ritu Bhatia welcoming you all to the YouTube channel of Edu Notes. In this video, the topic I am discussing is of class 11th accountancy, which is basic accounting term. The accounting term is of business transaction. A business transaction is an economic activity of a business that changes its financial position. Whenever any business transaction takes place, it will result in change in value of some asset, liabilities or capital. The chief features of these transactions are it involves an economic activity. Transactions are classified into two types, external and internal. It brings change in the financial position of the firm. The changes are expressed in terms of money. We will discuss about the accounts. Account is a record of all business transactions related to particular person or item. In accounting, we keep a separate record of each individual asset, liability, expense or income. But before understanding about the debit and credit, it is essential to understand the meaning of accounts. All accounts are divided into two sides. The left side is called debit side and right hand side is called the credit side. Next, we will discuss about the capital. Capital is an amount invested by a proprietor in a business enterprises. It is an amount with the help of which goods and assets are purchased in the business. In order to calculate the amount of capital, we have to deduct liabilities from the assets. Next, we will discuss about the drawings. Drawings is any cash or value of goods withdrawn by a owner for its personal use or making any private payment out of business fund are all included in drawings. Next, we will discuss about the liability. Liability refers to the amount which is paid to the outsider. Liability may be classified into two parts, internal liability or external liability. Internal liabilities are those which are paid to the owner or proprietor, and external liability are those which are paid to the outsider. Liabilities can also be further classified into two parts, which is long-term liability or fixed liability or short-term liability or current liability. Long-term liabilities are those whose payment fall due in a long period of time, and short-term liability whose payment are made in near future, or it may be within a year. The next accounting term is of asset. Asset is anything which enable a business enterprises to get cash or benefit in future. It includes all cash, bank balances, stock, furniture, machinery, land and building, bills receivable are all included in asset. In other words, we can say asset are the future economic benefit, the rights of which are owned or controlled by the organization or individual. The three main characteristics of assets are asset must be valuable, asset must be owned by the business, asset must be acquired at a measurable money cost. Next is classification of asset. In this first we will discuss about fixed asset. Fixed asset refer to those assets which are held for continued use in the business for the purpose of producing goods and service, and it is not meant for resale. For example, land and building, plant and machinery, furniture, motor vehicle, etc. Secondly, we will discuss about current asset. Current asset are those assets which are meant for sale or which the management want to convert into cash within a 1 year. These are also termed as short-lived asset or active asset. Example of current asset are stock, bills receivable, debtor, etc. Usually, stock and investment are shown in balance sheet at cost or realizable value, whichever is less. Bills receivable and debtor are shown at estimated realizable value, and cash in hand and cash at bank are shown at actual figure. Third classification of asset is tangible asset and intangible asset. Tangible asset are those assets which can be seen and touched. Example, land, building, furniture, stock, etc. Intangible assets are those assets which do not have any physical existence. Example, patent, know-how, etc. Fourth category of classification of asset is liquid asset. Liquid asset are those assets which are either in the form of cash or can be converted quickly into cash. Example, cash, bills receivable, debtors, etc. Next accounting term is of capital receipt and revenue receipt. First we will discuss about revenue receipt. Revenue receipts are shown on the credit side of trading and profit and loss account. Few receipts are included in revenue receipt that are money obtained from sale of goods, commission or fees received for service rendered, interest and dividend income received on investment. Next is capital receipt. Capital receipts are shown in balance sheet either as a increase in liability or reduction in value of asset. Few items which are included in capital receipt that are amount received from sale of fixed asset or investment, capital contributed by proprietor, partner, or money obtained for issue of share debenture in case of company. Thirdly, amount received by way of loan. Next we will discuss about expenditure. Expenditure include two types of expenditure, capital expenditure and revenue expenditure. First we will discuss capital expenditure. Capital expenditure is any expenditure which is incurred in acquiring or increasing the value of fixed asset. Such expenditure are usually benefit for a long period of time. Example, purchase or erection of plant, building, etc. Next is revenue expenditure. Any expenditure the benefit of which is received during one accounting period, and such expenditure help in maintaining the existing earning capacity and also does not bring into existence any asset of enduring nature. There is also a third type of expenditure which is deferred revenue expenditure. Deferred revenue expenditure is revenue in nature and the benefit of such expenditure is likely to be derived over a number of years. The benefit of such expenditure generally lasts between 3 to 7 years. That means whole of such expenditure is not debited to the P&L account of the current year. Only part of such expenditure is taken into P&L account every year and unwritten portion is allowed to stand on asset side of balance sheet. Next we will discuss about expenses. Expenses is a cost incurred in producing and selling the goods and services. In other words, we can say expenses is a cost of using things or service for the purpose of generating revenue. There are following items which are included in terms of expenses, that is, cost of revenue from operation, amount paid for rent, commission, salary, etc., or decline in the value of asset caused by the use of asset for business purposes, or in other words, we can say depreciation. Next definition is of income. Income is a surplus of revenue over the expenses. If we want to calculate income, we have to deduct expenses from the revenue. Next we will discuss about the profit. It is an excess of total revenue over the total expenses of a business enterprises for an accounting period. Profit increases the investment of the owner. Next definition is of gain. Gain is a monetary benefit or profit or advantage resulting from the event or transaction which are incidental to the business, such as sale of fixed asset, winning a court case, or appreciation in the value of asset. Next we will discuss about loss. The term loss conveys two different meanings. Firstly, it conveys the result of a business for a period when total expenses exceeds the total revenue. Second, it referred to some activity against which firm received no benefits. Next we will discuss about purchases. The term purchase is used only for the purchase of goods in which business deals. In case of manufacturing concern, goods means acquiring of raw material for the purpose of conversion into finished product and then sale. In case of trading concern, goods means are those things which are purchased for resale. In both the cases, purpose is to make profit by its resale. Next definition is of purchase return. When purchased goods are returned to the supplier, these are known as purchase return. Such returns are also termed as return outward. Next we will discuss about sales. The term sales is used for the sale of those goods which are purchased for resale purposes. It also includes revenue from sale provided to the customer. The term sales never used for sales of asset. Next we will discuss about sales return. As we all know, sometimes customer might return its goods which are sold to them. This return is known as sales return. In other words, sales return is also known as return inward. Next accounting term is of stock or inventory. The term stock includes the value of those goods which are lying unsold at the end of the accounting period. Stock may be of two types, opening stock or closing stock. Opening stock means the value of goods which are lying unsold at the beginning of the accounting period. This is known as opening stock, whereas closing stocks means the value of goods lying unsold at the end of accounting period. As per the manufacturer concern, this opening and closing stock will also be of three types. Stock of raw material, that means raw material purchased for using them in the product manufacture, but still lying unused. There is also stock of work in progress, which is partly finished good or semi-finished good, which needs further processing. Next is stock of finished good. Stock of finished good is completely processed and ready to use, but lying unsold at the end of the accounting period. This definition is of debtor. Debtor represent those person or firm or customer to whom goods has been sold or service are rendered on credit and payment has not yet been received from them. There is another definition of account receivable, which is usually related to debtors. Account receivable is an amount owed by a customer for purchase of goods on credit. It is usually a payment which company will receive from its customer who have purchased its goods on credit. Account receivable is written in balance sheet as a current asset. Next term is of creditor. The term creditor represents those person or firm from whom goods has been purchased or service procured on credit and payment has not yet been made to them. Some money is still owed to them. Another related definition of creditor is of account payable. Account payable is an amount due to the vendor or supplier for goods and service rendered that has not yet been paid for. It is represented as a company's obligation to pay off the short-term debt to the creditor or supplier. Account payable is usually appear in the balance sheet under current liabilities section.